Hello, everyone. Welcome to another edition of our More Than Market series. My name is Shalon Williams, Director of Investment Management Services here at NEI Investments. Today, I will discuss the recent Bank of Canada rate hike, as well as our general market views for the second half of this year. So for the first half of the year, the dominant story in financial markets has been inflation, which has underpinned everything from central bank policy, daily consumer expenses, volatility in stocks and bonds, and the risk to near-term economic growth. The inflation narrative has shifted from what was previously thought to be something that was a short-term development to something that has become a bit more entrenched, a bit more broad-based. And we saw that very recently in the US CPI print for June, where consumer prices exceeded 9%. CPI was at 9.1% year on year for June. And we're seeing where central banks have become increasingly more resolute in their decision to tackle inflation. And we saw that very recently with the Bank of Canada. On July 13th, we saw where the BOC increased the pace of tightening, increasing its overnight target rate by 100 basis points to 2.5%. That was a surprise move that was beyond what was expected, beyond what was anticipated. This was the first 1% hike since 1998. The BOC also revised downwards its outlook for Canada's economic growth for this year and also for next year. So the move that we saw for July 13th, it was pretty sizable, but it really indicates that the central bank is really determined in terms of bringing inflation back to target. Canada's inflation levels in the MEI reading was 7.7% year on year, and that really reinforced the need for the BOC to act very aggressively. We do expect rates to rise further, with the pace of those increases being guided by the ongoing assessment of the economy and also the assessment as to the path of inflation. The BOC revised its 2022 economic outlook downward to 3.5% from 4.25% in April, and to 1.75% from 3.25% for 2023. As the BOC's monetary policy results in tighter financial conditions, we do expect that to flow through in terms of a slowing in terms of economic growth. I know that there have been a lot of talks about the possibility of a recession happening. At NEI, we believe that the odds of a recession, those odds have increased to over 50% over the next 12 months. However, if Canada slips into a recession, we think that it will be a very shallow recession, given that the underlying economic strength still looks very good. And that's a similar view that we have for the US economy. On the US side, we expect retail sales to decline as consumers move from durable goods consumption to services. We do expect to see unemployment rates move slightly higher from their historically low levels as companies deal with overcapacity and overstock. However, in terms of economic strength, sources of economic strength include company earnings and profit margins, which are in fact growing remarkably well. Earnings growth estimates for the S&P 500 index remain strong at 11% and 8% for 2022 and 2023. Company earnings remain resilient with moderate growth rates. However, with the rising input costs, that could place some amount of downward pressure on earnings, causing some amount of revision to those estimates. However, July will be a month to be on the lookout for, because that's when we'll see the second quarter earnings. And we'll be keeping very close eyes and very close tabs as it relates to what it means for profit margins, as well as the earnings growth outlook as earnings season kicks into high gear. As it relates to investors, the path for investors really hinges on how quickly inflation moderates. There are signs that point to some easing of inflation pressures. Higher prices, higher rates tighter financial conditions could curb demand, so much so that we could see inflation rolling over. However, there is still some amount of uncertainty as to the path of inflation. And given the inflation uncertainty and by extension, the course that the market can take, it means that portfolio diversification remains very key for investors. Any significant position tilts could prove quite costly. As such, the role of the trusted advisor remains critically important at this time to ensure that clients adhere to their long-term investment goals, with their asset mix, being geared towards achieving those long-term objectives. So with that, I close. I'd stop here for now and say thank you for tuning in. Hope you found today's discussion particularly helpful. Watch out for our next edition of our More Than Market series. And as always, reach out to your NEI representative with any questions that you may have. Thank you, everyone. Stay safe. Bye for now.